Hey, good morning, everybody. It looks like we have a few people still filing in, so we're going to take about 30 seconds just to give everybody a chance to log on.
Sean, where are you at right now? What city?
I'm in Birmingham.
Birmingham, okay. Jim, I know where you're at. You're in Southfield. You're in our office. I'm at home in Washington Township, in the country.
I wish I was out there on the orchards right now.
Oh, yeah. It is. I'm kind of in a nice little spot between the Orchards, Greystone, and Glacier Club. It's three pretty good golf courses, very, very close.
I think we're probably ready to get started, guys, if you want to. And so first, I want to thank everybody for joining us today. My name's Sean Mercino. I work for Comerica Bank, but I'm representing the East Chapter group here. We're excited about this presentation on the PPP check-in, and we thank Clayton partnering with us on that. I see a few new names over on the people joined, so I just wanted to take a second, kind of give you guys a 30,000-foot view on RMA. It is a member-driven professional networking group who focuses on risk management, credit risk, operational risk, market risk, and it's a pretty interesting group that we focus on networking and educational events like this. So for everyone out there who thinks, hey, RMA is just a bunch of bankers, you guys should know that we have over 200 members from the industry and CPAs, lenders, legal counsel, consultants, and things like that. So definitely a wide range, diverse networking group. Hopefully you can join us. We have a series of WebEx events in the works for 2021, so keep your eye out for that. And everybody looking forward to next summer already. Monday, June 7th, down on your calendar, RMA will have their annual golf outing at Tanglewood Golf and Country Club. So hopefully we see you guys there for that. I did want to, before I hand it over, wrap up by thanking all of our sponsors. We would be unable to kind of grow our footprint and have these type of events without the help of our sponsors. So our platinum sponsors are Howard and Varnum, and then our gold sponsors, Comerica Bank and Great Lakes Business Credit, and then our silver sponsors, Dorn Flagstar Bank, Partners, Level One, and TCF. So thank you guys very much for being a part of the group and sponsorship. It goes a long way. So thank you for that. Next, I want to introduce, we have Tim Hilligoss and Jim Beal working from Clayton on this PPP presentation. So I will take it off and hand it to them.
Thanks, Sean. Welcome, everybody. Look forward to having hopefully a very good discussion on kind of a different side of the PPP loan program. Jim and I have spent a lot of time working with clients on the initial application, the qualifications throughout the process of managing the loan, and then subsequently the loan forgiveness application. And of course, throughout that process, there's been many changes, both with frequent questions and interim final rules. So kind of a different perspective to talk some of the things we're seeing and be able to share with you the accounting concepts that you might be seeing or the considerations your clients might have, and also share a little bit about where our thoughts should be kind of on a go-forward basis. So a little bit of housekeeping here before we go ahead and introduce ourselves. I want to let you know about this format. This is something that Clayton and McCurvey's been using for quite a few months now to kind of have these live video presentations. And you'll notice on your screen there's a question section. And ideally, this is where we're looking for your input on information or things you'd like for us to share. It may be covered within the presentation itself, and you might see Jim or I click on that we're going to answer that question live, or we may answer some of the questions offline through typing. But there's a really neat feature within this program, and there's an upward triangle or a little black triangle, and that's called an upvote. And if you see a question that somebody's asked and you click on that upvote, what it's basically telling us is you're not going to retype that question, but this is a question you're considering. And it lets Jim and I kind of rank the priority. So as we're looking at those upvotes, we'll know what kind of questions are most important to you. So we plan to get done on time. If I know that I have some flexibility and some availability, so if we're getting through some of the questions, or maybe there's just a few questions lingering, we might trickle over. But certainly, we're going to make this presentation available as well as the Q&As that come through. We'll make those available. So if you have to leave at 12 o'clock, by all means, go ahead. We'll make sure you get the information you need. With that, I'm gonna ask Mr. Beal to maybe go ahead and introduce himself, give maybe a little background on the firm as well.
Good morning, Jim Beal. I am a shareholder at Clayton & McCurvey. Been over 25 years. I guess I use 25 years. It sounds better than maybe what it actually is. 25 years in public accounting. I run a book of business of approximately 40 different clients. And my responsibilities also include running our PPP team. So we have a group of staff that do forgiveness application reviews, answer questions, even go on the portals and help the clients get the information in for the forgiveness. The firm's been around since 1953. We are a niched practice towards closely held businesses with usually an international slant, either outbound international or inbound international. So you'll see quite a bit of activity. We don't do public companies or not-for-profits. We focus on, hopefully, for-profit entities. So that's about it.
Great. Thanks, Jim. And I'm a fellow shareholder with Jim, Tim Hilligus. I work in our insurance department. And like Jim, closely held businesses. So this is something we're managing with our clients every day from the beginning back in April with the application process to now. I think within my portfolio, just to give you kind of a lay of the land, I had one client who did not apply for the PPP loan. So within my client base, virtually 100% have applied for PPP loans, and in some cases, in addition to that, the EIDL loan. One of the things that I want to kind of make sure we understand before we get started, and Jim and I have hosted many of these events on the PPP loan. I want to make sure we clarify some of the things we're not going to be talking about today. We've hosted, I think, 9 in total live videos on both the loan application, the loan forgiveness process, and many of the changes that have occurred through that. And today we're really focusing on kind of more of a client consideration, an accounting consideration, and lender consideration. So what are some of the things related to financial statement presentation that many of the lenders online would be experiencing or be expecting to experience or see as their clients kind of work through this process of posting the loan, considering the monthly or interim aspects of it, and what they might see with respect to a year end. So if we have availability or time, it may be that we do answer some specific questions about the forgiveness application. Jim and I enjoy this, so there may be some questions will be easily flow into the presentation. So let's kind of get started with kind of a recap of where everything is. A little over 5.2 million loans, $525 billion in loans. In total, I think that there was about just under 140 billion available, and 5.4 million lender counts. And the lending base was pretty broad on this, from the national banks all the way down to some very small online banks, including, I think, PayPal and a few other online resources were invited to kind of put this money out in the market. Here's one of the best resources I can share with you. If any of you have questions related to the PPP loan process, the rules or the laws that are in place, you want to look at the instructions or look at the forms. I can't say enough about the treasury.gov website. It's a great resource. Jim and I still circle back and we'll look directly at the CARES Act to see where the law stands on many of the changes that occurred. But just to give you an idea of kind of the volume of information that's available on the treasury.gov website, you've got the 3 applications for forgiveness and all of their instructions. And so those are your 50,000 and less, those who've had no reduction in workforce in payroll or wages, and those that have. So those are your 3 methodologies for applying for forgiveness. There were 25 interim final rules, which essentially are laws that changed the CARES Act. The CARES Act introduced the PPP loan program and kind of set the foundation. And the normal process is there'd be a Q&A period, there'd be a feedback period, and without that, they had to have some other methodology to update this, and so they used the interim final rules. So we had 25 interim final rules, which affected from the initial, the need discussions, for those of you who remember the LA Lakers or the Ruth's Chris or the Shake Shacks and the political turmoil that created, to those of you who may have foreign employees. How do foreign employees count against or for or affect your ability to qualify for a 500 or fewer employee level? So a lot of things in those interim final rules. 53 frequently asked questions, and we're up to 28 frequently asked questions with respect to the loan forgiveness application process. The most recent change being 10/13/2020. So we're at almost exactly 2 months without much change. That's not too bad when you think about it, but I think so many people are still anxious about that process of applying for forgiveness. Where are we at? Where do we see things? Most of our clients have applied or applying for forgiveness. I think in my portfolio, I am at 50-50. So 50% have already submitted their applications, and about 50% are still in the process of calculating that. We've got some rules that are in place. The banks have 60 days to review your application and approve or send it back to you with either feedback or corrections. And then the SBA has 90 days upon that submission in order to make a decision on your loan forgiveness. A couple of those anxious things that occurred, there were some banks locally that, and I think nationally, that had some delays in accepting applications, as well as now accepting applications for forgiveness. So I think that certainly adds to some of the anxiety. And of course, anybody who's in the greater than or equal to $2 million loan will have an additional criteria. They're actually going to be reviewing their loan documentation and are required to submit an additional questionnaire, a Form 3209, which basically asks a substantial amount of questions to kind of determine that need. What that means is anybody below $2 million automatically qualifies or met the necessity. Doesn't mean there couldn't be an adjustment to their loan forgiveness, because of course they still have to fill out their proper form and determine what's my actual forgiveness percent. So there could be reasons that they may not have forgiveness because of either a decline in workforce or a decline in wages or payroll, and those could be impacting them. Yeah, go ahead.
It's a 3509.
3509.
3200. Yeah, 3509.
3509. Yeah. There used to be a form called a C3200, but 3509. Thanks, Jim. So where are we at now with this application? So we're seeing some of the banks are using third-party reviewers to review information. So we've already had some interaction with our clients where they've submitted forgiveness applications, and we're getting feedback from third parties saying, hey, we need a little bit of information there. There were some banks that sent out letters to their borrowers indicating a kind of a hierarchy of when they would start accepting applications. But I am 99.9% sure I believe everyone is accepting loan forgiveness applications at this point. At least within my portfolio, everybody is eligible or able to now submit. One of the biggest rule changes we had, and maybe you saw this with your clients where they had to go past the 8 weeks, and the rules in general kind of slow down the process, but I am sure you probably had some people submit applications for forgiveness, and then we had this affiliate rent rule come out, which reduced the ability for those who self-rent. You may have clients who have their business in a certain tax structure and then have their building in another tax structure. it limited the amount of rent that would be eligible as a covered expense to the mortgage interest for an affiliate rent. And so what that did is that pushed some of our clients out past the 8-week mark, which meant, of course, gathering more data. But overall, we're seeing certainly both bank and SBA approvals pick up. It's probably the best email I get from a client is letting me know that they've got final approval for forgiveness. So Jim, any thoughts on that? I think you're on mute.
There's a lot of concerns and questions relative to the process, but it seems to be relatively easy process with the portals. What we found so far that you can get through it, and it's fairly quick. It's much quicker than I thought it would be on some of the responses that we're getting. We've gotten a number of forgivenesses already. Once it gets to the SBA, they're coming back fairly soon, so that's good. Yeah.
So what? Let's talk a little bit about some of the unknowns that we have. I got a little pop up there. So right now, this could be another great week, to be honest with you. So Steny Hoyer, the House Majority Leader, asked congressmen and congresswomen to come back to Washington, D.C. this week, and particularly today, to potentially vote on a new stimulus bill. So that, to me, is pretty exciting. I will say this. We talk about this within the office. There's a chance we'll never see anything quite like this in our lifetime. And for the most part, they're just building on, I think, value or contributing to the economy in a valuable way that we're seeing within our client base. So I'm optimistic that there'll be some good things. They had been hung up on the total spending package, and a couple of the key things were how much local aid would come about from these bills, the state and local aid, and then the potential for limiting liabilities to businesses involved in this program. So those were a couple of the things. I think, Jim, you were just checking recently and said, why don't you tell everybody what you just shared with me a few minutes ago?
Well, I've been tracking the market to see what's happening with the market. I guess that's an indicator or a leading indicator where the talks are going. The markets across the board are up. So the Dow's up 143 points right now. So the talks must be going well. They must be belief that we're going to get to something that should be announced today, we hope. So we're waiting for that.
Yeah, I think two of the things we're most interested in hearing, besides the fact that there could be potential ability for more stimulus, especially for those businesses who continue to get hurt by some of the quarantine restrictions that are occurring at their respective states. But two big things for us, probably one bigger than the other. But where will they put this forgiveness floor right now? So right now we've got the ability for somebody under $50,000 to virtually submit an application that kind of green lights their forgiveness at $50,000. Is there a potential that they could increase that floor? Many senators and congressmen and women were discussing a $150,000 threshold. So who knows? Maybe we'll see something that for some of your smaller clients will give a little easier, take some of that anxiety away and give a quicker green light for more loans within your portfolios. And the last bullet there that will the covered expenses be deductible? For those of you who've been following this, about a month and a half ago in October, the IRS came out with their final revenue position on the loan portfolio, the PPP loan forgiveness. And while the CARES Act specifically excludes loan forgiveness from taxable income, the Internal Revenue Service applied kind of the grant tax treatment to this forgiveness, which is if the source of that income was, or one of the drivers to achieve forgiveness was to use those funds in deductible expenses, they were going to then deny the expense deduction. So, for example, a client of yours that may have gotten $1 million PPP loan and therefore use that $1 million for payroll, rent, utilities, mortgage interest, things like that, that $1 million worth of expenses would be non-deductible. And what they most recently came out with was that non-deduction was going to occur in 2020. So if some of your clients were looking to defer the tax bill for that forgiveness to 2021, the IRS has come out and said, we're not going to allow that. If you plan to apply for forgiveness, you expect forgiveness, then you will need to reduce those expenses. And so just to do the math on that, $1 million S corp $1 million PPP loan to an S corp could result in federal tax wise about a 30% tax cost, potentially up to 37, depending on if they qualify for what's called the flow through qualified business deduction, which is a 20% deduction on taxable income. For C corps, it would be a 21% tax cost. So, in either scenario, it could be up to as high as 37, as low as 21% of kind of a give back on the tax consequences. So we're hopefully optimistic that this week we'll get some conclusion on that. I can tell you as early as May, there have been House bills in the House of Representatives that were pushing to get this fully deductible. So all the expenses fully deductible. And as I mentioned, the loan forgiveness was already not taxable. So as early as May, this legislation has been in Congress's hand. And unfortunately, it's kind of pushed further. Some other issues, this Form 3509 that Jim mentioned, the form number, this really is kind of the rub that's occurring right now for those who borrowed $2 million or greater, because you've got almost every trade association writing the SBA and saying, wait a minute, this is kind of a bait and switch. At the date of our loans, we assessed our need and we thought this loan was necessary. And now to use hindsight to determine, did our business decline? Did by the luck of the economy or the necessity of what we do, did we not get harmed by the COVID outbreak? So now they're kind of using hindsight to determine, do you qualify for the need for this? They're asking about cash flow. They're asking about your performance comparing 19 to 20. So I think it's raising the hair on the back of a lot of people's necks who borrowed greater than $2 million on, is there a chance that their loan may not be forgiven because they don't meet the need criteria that was assessed?
Tim, what will happen is they'll submit their forgiveness and get forgiveness on the initial stages, and then they'll have to fill out the 3509. And the 3509 breaks it down into basically two buckets: business activity, which asks, is your volume down? They really want to know, is your volume down in 2020 versus 19? And then the second, were you shut down? Were you shut down voluntarily? Were you shut down by the state or the federal government? That seems to be an impactor to them under the business activity. And then they want to look at your liquidity situation. So once that goes through review, and that seems like that should take a lot longer than the original forgiveness review, it could be denied to where they won't come after you for federal prosecution saying you didn't deserve the loan in the first place. They would merely make they would make them pay it back under the structure of the loan as it originally existed.
Yeah, and thanks for that, Jim. I think it's important to understand that nobody can give you that any guarantee on this. And if you go back to the beginning of this, I keep saying this at many of these live videos. I keep talking about this court of public opinion. You just don't know how much public information will come about when somebody either feels that a wealthy neighbor, a wealthy business, hey, how did they get loan forgiveness? I think there's more to come on that, and the criteria may actually shrink. It may get tougher. You never know. There's two things I want to share related to that specifically. There are some current lawsuits. I'll call it, for lack of a better term, we'll call it a bait and switch. So there are some lawsuits that were initiated early on with the PPP loan program because recipients or potential borrowers felt that there was a bait and switch. The CARES Act set a very simple, I'll call it simple, or very meagerly defined rules for qualifying for applying and receiving a PPP loan. And it's the SBA that brought in all this criteria. And so those lawsuits are essentially saying, wait a minute, you can't create, this hindsight criteria that's not in the law. That's not fair to those who've applied for these loans and received these loans. So there could be some relief that could come down the road, especially related to the criteria that's within this 3509 form that Jim described. There's two things that this tax legislation or potential stimulus legislation and allowing the deductibility of your covered expenses to flow through would have a negative impact. If those expenses are denied, there's two components for S corps and partnerships where they are allowed a 20% deduction called the flow-through deduction, or Section 199A deduction. There's a potential that having lower wages or lower qualifying wages, because those covered wages would not be deductible, could reduce your benefit of that tax savings device that is currently a benefit, a 20% deduction benefit for flow-through entities like partnerships and S corps. And the other is for those of you who receive research and development tax credits. One of the two largest components within research and development tax credit, the bucket of expenses that qualify for credits, are component costs and labor. And so there's a potential, if they don't make some corrective action, that we might see lower research and development tax credits because the qualifying expenses, the labor qualifying expenses, may be reduced because of the IRS's treatment under this grant methodology of saying, hey, if the sources of those expenses were required to receive this for forgiveness, then you can't take the deduction for those expenses. Hold on one second. I'm on like about a 10-second delay here. So we talked about the lawsuits, had a couple of cases of fraud. Most of the fraud has been applying for loans where you didn't qualify. It wasn't related to any certification or those that were legitimate. These are cases where people who didn't have payroll or didn't have meet the requirements or meet the criteria for loans went and still applied for loans and were able to get them. A couple lack of clarifications just so that we understand what are some of the things that are out there. We get these questions all the time. They still haven't come through on firm definitions of transportation expenses or utilities. So we got those questions a lot. So when you're thinking about your clients submitting that application and they're hitting you with, garbage utilities, their Comcast bills, things like that, there is no clarification. There is no bright line test for what falls into that. And there's no bright line test for transportation costs either. There is some mention of transportation costs in the self-employed EIDL, where it allowed self-employeds to qualify for the PPP loan, where it talks about any transportation costs. So, that could be fuel, oil changes, repairs and maintenance, and things like that. And one of the other items that came up quite a bit is the common area maintenance charges that very often your clients may be billed once a year. How do those are really deferred rent when you think about it. How are those impacting the covered expenses for PPP? And the other thing that hasn't been addressed is for those of your clients who did apply for what was called the EIDL grant. The grant allowed them a kind of a quick stimulus of up to $10,000 within 3 days of their application of an EIDL loan. The EIDL loans have been around for many years. Those relate to disaster areas. So down south in our coastal cities are very familiar with that process and those loan programs. What the EIDL grant brought was a quick way for you to apply for this loan. You still didn't need to necessarily accept the loan, but based on your payroll or your labor in force, you could get up to $10,000 within 3 days. What they haven't addressed anywhere is, well, does that $10,000, is that treated differently? Because it is a non-taxable grant that had no criteria. It has no criteria that you spend it on payroll. So again, in the materiality realm, compared to many of the loans our clients are receiving, the $10,000 EIDL grant is pretty immaterial, but I wanted to make sure at least that I mentioned it to you. Some of the things your clients may be considering right now and might be adding to some of their anxiety or some of the stress that they're facing is, more than likely, especially with some of the changes related to rent, they've probably had to go after a covered period after 8 weeks. So they're now gathering data. They're using third-party payroll. Maybe they're using their own. When the government expanded the program to 24 weeks, it, of course, required a little more extrapolation of the limiters, the $100,000 limiters for an annualized wage. So you may have clients who are still working through the number of weeks. I think, if I had to kind of throw a dart at the wall and say, where are our clients? I think my clients are somewhere between 11 and 14 weeks, probably the most of them. to get full forgiveness. Had the rent not been adjusted, it probably, many of my clients probably wouldn't have gone past 9 weeks. So that was a substantial adjustment. One of the other considerations, there was a June 5th, some new terms for any amount of PPP loan that might not be forgiven. And if you remember, the original CARES Act proposed a 2-year installment note. And in June, they came out with a 5-year installment option for those people who received their PPP loans after that date. So one thing, your clients who aren't expecting 100% forgiveness, they may ask you to consider amending their loan agreement to look at a 5-year payment plan versus the 2-year payment plan that they might have been grandfathered in because they applied early on in the process. So that may be something for them to consider. I think that we have to be prepared for ongoing uncertainties. The rent, the potential, the rent one comes to my mind because I know people applied before they came out with the affiliate rent rules. So I know there were probably some companies who had to resubmit their applications for forgiveness to make those changes. But, thankfully we haven't seen anything since the middle of October. But if we get a new stimulus bill here this week, obviously, all the professionals are going to digest it and determine, well, how does that impact somebody who's in the middle of applying or has perhaps already applied for forgiveness? Could there be some changes that might happen there? So I think that continuous changing may create some concerns for your clients. And some may be taking the approach of, since it's likely to take a few months for me to get forgiveness, and there's no time limit necessarily for me to apply. I think the final, there is some criteria for when their loan might have to turn into an installment loan into 2021 if they have not applied for or received forgiveness. But some of your clients may be using hindsight to apply for forgiveness until we kind of get through some of these unknowns we're talking about, or maybe understand, hey, do I maybe qualify for a de minimis forgiveness? If they increase that to $150,000. So I think that uncertainty may be pushing some people to defer submitting their applications for forgiveness. This is kind of something we've been talking about in the office, which expenses to include in your forgiveness application, since it may affect other tax schemes. Jim has some thoughts on this, but let me just kind of give a lay of the land here. When you think about R&D credits and you think about qualifying for this flow-through deduction, the buckets of potential denied payroll may impact your overall tax consequences in 2020. So, does it make sense to include a bigger bucket of expenses, and then you can pick and choose which ones are not ultimately deductible if the tax laws stay the same? Or do you do what many of our clients have done, which is once they knew payroll, once they could go past 8 weeks and use payroll as the sole qualifier for covered expenses, did they really need to now go get their health insurance bills, their utility bills, their rent bills, their mortgage interest bills, and submit those? So I think you may have clients who are digesting what's the best way. Is it just enough to achieve 100% forgiveness, or do I put it all in there and kind of get the hindsight ability to decide, well, if my CPA tells me it could affect my R&D or my flow-through deduction, do I want to put more expenses into this bucket or different payroll expenses into this bucket to at least avoid that? And we may know a better answer this week. But Jim, do you want to?
Yeah, well, part of the issue came through when they extended it from 8 weeks to 24 weeks. And then when we went to the 24 weeks, you look at the forgiveness application, it says, give me your payroll expenses for the 24-week covered period. It doesn't say, give me the payroll expenses paid during the 24-week covered period that are supported by the PPP loan. So if you get $1 million PPP loan, you think, well, I should only be able to put $1 million of payroll or other costs into my forgiveness application. That's not what they're asking. You could put $3 million of payroll costs and other costs in, and your FTEs or your reduction in your employees could be dramatically reduced during the covered period, and you still get 100% forgiveness. There's a concern out there that they might change the rule, or they were going to change the rule, but I saw some on the last final reg that they kicked out. They talked about the banks only needed to review the cost up until the forgiveness amount. So they're aware that people are submitting expenses well in excess, but some don't want to go through the onerous task of doing all 24 weeks. So they want to cut it off at 16 weeks. And the only caution I have is when you get to the application process, if they throw anything out, you don't want to end up short. I don't know whether they would be allowed to amend your application after the fact if they threw any cost out, or the 199A, if you're getting all payroll, you have to apply it all against payroll on the forgiveness if they don't change the law to allow you to deny to get the deduction. If you can't get the deduction on the payroll, you won't get the 199A deduction. It could have an impact.
Yeah, one of the things, and I'll chime in really quickly on kind of the logistics of the application. There is nothing that would prevent you from utilizing certain expenses more than others within the forgiveness process or application. So, if your payroll covers everything you need, it doesn't necessarily mean that you still need to submit your rent or submit your utilities. So there isn't a bright line or a rule that says, hey, you have to do this. So for those of you who are asking questions about, hey, can I just use payroll as my factor? Absolutely. But I think we wouldn't be doing our jobs if we didn't tell you that, if rent and utilities and mortgage interest weren't substantial, there's the potential that these things may not be deductible. Your rent, your utilities, your mortgage interest aren't going to impact the two tax benefits that Jim and I talked about, the R&D and the flow through, whereas payroll will. So I think you've got to think about how substantial are those other components versus the ease of applying and just running your payroll reports off of your ADP or Paychecks or Paycom or whoever you're using, or doing it in-house. And the second thing I saw came up, a question about segregating these funds. And I go back to when these loans first started. We were fairly adamant with our clients that if they had a PPP loan account, they should only draw those funds out to pay the bills that they were incurring. In other words, don't just wire all that money into your general account. Use that as it was intended. It's meant to cover your next 8 weeks of payroll and cover your rent. Now, one of the questions is, well, we used our general checking account, but we didn't shift our funds out of the PPP account. I think the substance over form here is you've got legitimate covered expenses that you've paid. Those funds are somewhat fungible. I think our concern early on was people using those funds too quickly before they could legitimately be used for payroll, rent, mortgage interest, and so forth. So I think for those, one of the questions was, I've got some money still in that PPP bank account, but I've used my general checking. I think you're fine, because the substance is going to be within your application. You're going to have qualified covered payroll, rent, utilities, mortgage interest, and the like. So I think you're fine there. Any other comments, Jim, before I go to the next?
No. I think that's good. Yep. Move forward.
All right. And the last thing is the accounting treatment, which is what we're going to kind of focus on here from this point. So there isn't any specific guidance that's out there. And when Jim and I say that, it's kind of like tax laws. The accounting rules are very written to apply to very specific facts and circumstances. So when we say, there isn't a specific circumstance where a for-profit organization has received government support or a government loan with the expectation of forgiveness, that isn't out there. And so what the accounting rules allow your clients to do, whether they're whatever accounting standard they're using, it allows them to look at, well, are there any other analogical applications or other pronouncements that might apply that are a primary source or a principal similarly sourced authority that we could utilize. And there's three that really everybody's focusing on right now. And that's the traditional GAAP treatment of debt. There's the international accounting standards for grants that companies receive. And then there's the accounting for contributions that not-for-profits face. If you think about it, there's a lot of analogies to, how do you handle traditional debt forgiveness? How do you handle government grants within generally accepted accounting principles or international accounting standards? And how would you handle as a charity potential contributions that may have some criteria that need to be earned. So those are the three things we're going to talk about. They all have one thing in common, and that is they have a pretty broad touch to the financial statements your clients will be preparing and that you'll be reviewing. All of these will have some impact on their balance sheet, their profit and loss, their cash flows, and most importantly, their footnotes. The footnotes is kind of the backstop of, did I net something? Did I not disclose it? Did I not segregate it appropriately on my balance sheet? Maybe GAAP says I'm supposed to net it out, net my forgiveness against the loan itself, as opposed to show the loan and the forgiveness accrual. What the footnotes would allow your clients to do is really describe how they've accounted for this. So we're going to go through those three criteria, or the three I can never say that word right. The three applications of other primary sources that you may see your clients utilize as they're preparing their 2020 financial statements. So the first one is the traditional debt treatment. This is, I'll call this more the cliff approach, which is, hey, I've got a traditional loan. I've got to accrue my interest. I've got to determine how much of this is traditionally, potentially short-term or long-term. But until I have a relief of that legal obligation, I've got debt on my books. And so you may have clients who take the traditional GAAP debt approach, which is, while I may expect forgiveness, anticipate forgiveness, I'm going to take the approach of under ASC, the codification 470, that I'm not eligible to account for debt forgiveness until I legally receive that forgiveness. And that would be when they get that document from you and they sign off that it's the steps after they get the SBA approval. It's the point where you say, hey, here's the legal documents that you sign that say we don't have to pay that debt. So in that case, you're gonna see the traditional sources of financing on the cash flow from financial sources, and you're going to see the notes payable, potentially PPP loan payable on your client's balance sheets. Okay.
And Tim, I guess you have to have an SBA letter of forgiveness to be able to bring that into income. Is that?
Well, I interpret it as you are no longer legally responsible. In other words, I have signed, and the bank has signed something that says I am not responsible for that loan anymore. Okay. So to me, that's the last I dotting and T crossing, is I have no legal responsibility to pay it back. I'm not going to take the approach of perhaps accruing the forgiveness. I'm going to take the approach of I'm no longer legally responsible for that debt. Okay. Understand. The second one relates to the grant programs. And so this is not prevalent in our client base with closely held businesses. Occasionally it does come up where someone gets a grant associated with a particular hiring of either, could be minorities, it could be certain impoverished demographics, perhaps military or felon.
Energy project as well, Tim.
Yeah. So this is applying, hey, how do we handle these grant monies when they come in, and then how do we handle what I would say is the amortization or the utilization and meeting the qualifications for forgiveness? And so that's where we fall into the IAS 20, which, similar start, they all kind of start the same way, which is we're going to go ahead and book this liability on our balance sheet. But in this case, it's a little bit different. We're presuming that this is going to be a forgiven loan. And so we're essentially calling it deferred income. We're picking up that this liability is going to be a short-term liability on their balance sheet. And similar to the third version, where we're going to talk about the not-for-profit treatment, what you're looking at is what is the criteria for that forgiveness? And for many of your clients, that's going to be this period of April, May, June, July, August, maybe some are creeping into September and October. But there's going to be some amortization or matching of forgiveness as they meet the criteria of using that for their covered expenses. So that's their labor costs, their rent, perhaps their utilities, mortgage interest, things like that. So they would be picking up or accruing that income or recording that income as they incur those expenses. Okay. I think it's important to understand how does that get presented on the income statement? Because believe me, I've had as many clients say, well, do I just net my expenses on my P&L? In other words, if my labor was $1 million and I got a $600,000 loan forgiveness, I expect it, do I net it against my labor? And the answer to that is no. This would present it as other income. Okay, this should be separately stated on your profit and loss.
It could show it as a reduction of the related expenses, but you'd have to disclose that thoroughly to be able to do that as well. So yeah, you have to be very clear on that.
Yeah. Sorry, that's right. So in this case, we can net these against expenses, but we'd have to have full disclosure on how it was presented. And the details of the footnotes are going to be important. For most of your clients, by the way, who adopt this methodology and the third one we're going to talk about, you would expect to see full forgiveness within the 2020 financial reporting. And the reason we know that is December 31st is the last day somebody can have a covered period. Okay, so, makes sense?
Tim, question. I guess if I'm producing the financial statement, it's in March. The client submitted the application for forgiveness and they haven't received word back from the SBA as I'm getting ready to issue the financial statement. There's a decision management has to make as to whether it's probable that they're going to get forgiveness, correct? And that's what has to happen at that time. And they would have to, it could be the full amount, a portion of the loan, again, based upon their application, management has to make an estimate and make a decision at issuance, whether to pick it up into the income statement or leave it on my balance sheet as a liability. Is that correct? That's the correct statement from your standpoint?
Absolutely correct. And where you may see different discussions with your client base is obviously their CPA has to sign off. If they're getting a test services provided, if they're getting a compilation and they're getting a review or they're getting an audit, these things will need to be a part of that criteria or consideration for their CPA. The level of conservative or aggressiveness on that will probably be determined by that organization, their understanding of the application, their understanding of the client. And there could be some that are green lighted. For example, the ones right now that are $50,000 or less. I mean, those are not absolute, but certainly seem to eliminate any potential math or any potential criteria that could be scrutinized in a forgiveness application that would be looking at full-time equivalents and reductions in full-time equivalents or reduction in labor costs. So I think it'll be a dialogue with the CPAs. How are they handling it? What do they think is probable? And theoretically, I guess somebody could say, well, we're gonna not treat this as probable until we've had a chance to look at your application. And one indication may be the bank's acceptance of the application and submittance and ultimate submitting it to the SBA. So even if they haven't received forgiveness, but the bank has approved the application, that certainly could go towards their management's decision to say, hey, this is probable that we're going to receive forgiveness.
And Tim, on this one, I think you and I are both in alignment that at a $2 million, below $2 million, where you're getting, the need is automatic, you apply for a forgiveness. More than likely, if they've submitted for forgiveness, it's gone through the bank, it's with the SBA, or we've reviewed the application. It looks pretty good. The expenses look, correct expenses. We would probably say pick it up into income. If they're over 2 million and they have to go through the 3509, and that 3509 is hanging out there, I think there's a little bit where you're a little bit different than me. I think I'm more of the line. I think I would wait until that 3509 comes back, because we're not sure how they're going to interpret that 3509. Maybe we'll have better information as we start to see some of the applications come in, but that's where the rub's going to come on those that are over 2 million. On these latter two options that are available, is it probable or not? Do you pick it up into income, or do you have to hold it on the balance sheet as a liability and wait? And you're going to have a mismatch of the expenses and the income if you have to wait and leave it on the liability side until.
Right. Yep, I agree with you. The third criteria is the accounting for contributions that not-for-profits use. Similar to our discussion on grant accounting, you're basically booking a liability for the deferred income. and you're going to essentially amortize that income or recognize that income as you've met the criteria for forgiveness. So you could see, similar to the grant, your clients are going to be looking, if they got a loan in April, perhaps they're going to looking at their April, May, June, July. They're going to look at their wages and those covered period expenses and amortize that into income. Now, let's be practical. Many of our clients, I think almost all of my clients, have kept that debt on their books at this point. So these may be what we would call period 13 or December adjustments to get their financials, their year-end financials, in line with one of these three proposed options. So look for that. The one difference between the accounting for contributions under the not-for-profit method is it doesn't allow the netting. And so you would be looking at this as a separately stated item on the profit and loss statement. Again, you're going to have you should be seeing full disclosure with your clients on how they treated the accounting of their PPP loans, their PPP loan forgiveness, and if potentially they expect less than 100% forgiveness, how they've obviously then dealt with accruing the interest exposure that they will face on the amounts that aren't forgiven, and the term that they might have between current and long-term liabilities. Now, kind of going back to Jim's comment, you may have a client who initially records full forgiveness in 2020. What happens if that is somehow reduced either through the greater than 2 million audit, where they look at need or potentially make adjustments on the actual calculations, or perhaps there's an adjustment to the percent forgiven through review. In either case, you'd be looking at potentially a change in estimate in 2021, which would be reported in that current period. So somebody records forgiveness in 2020, and for some reason it is reduced or denied in 2021, that would be treated as a correction to a management estimate and would be reported in their 2021 financial statements. All right. What are some things for you guys to consider? I don't mean this in a harsh way, but we're all busy, and sometimes it's hard to get an understanding of the empathy that some of your clients have gone through in this process. Some where their businesses were affected dramatically, and some where their businesses maybe were not. You may have some that didn't see a dip at all, and ultimately this is a stimulus package that improved their financial position. So I think understanding where some of these companies have been through the application process, where perhaps their loan had initially denied their ability to apply with their current or traditional lender and seek third party or seek an alternative lender, the way the rules have changed. Now you've got the oversight. So many of the banks are using third parties to review the documentation. So you've got potentially your internal bank oversight, third-party reviewers, and then ultimately for those 2 million or greater, you're going to have the SBA oversight. So I think understanding that there's some anxiety that comes with, is this loan going to be forgiven or not? And that is, we're seeing a lot of our clients, this is probably the most important thing they're dealing with right now is this application for forgiveness process. I think the delays that have occurred all across the board from the beginning till now have created some frustrations within the borrower community. The changes in the applications and the covered expenses that changed. The rent one was probably the biggest one. Again, our clients are closely held. Many of them own their own buildings through a second company or an affiliated company, and that had a bit of a hiccup in their expectations and the timeliness of it. For those that were thinking they were going to qualify for forgiveness at 8 weeks, all of a sudden thinking about, well, okay, now what do I do? They got this June 30th safe harbor. What do I do now? Well, thankfully they put a lot of rules in place that allowed for reductions in full-time equivalents not to cost you. So there are some provisions that created some flexibility. I think the biggest thing I would say is keep your clients informed. I can't say enough, especially through the application process where some of the banks had set some criteria on who could apply. And then now through the forgiveness process where many of the banks were trying to get their software working. And what I think ends up happening is you get the water cooler discussions. Oh, my bank's already doing this. My bank's already doing that. And so what I would say is that silence of not knowing if their bank was going to accept the applications or when, I think created some concern amongst the borrower community. And the last one is, I'm not sure how this plays out. We've seen clients who were in the middle of renewing loan agreements where the PPP loan forgiveness is affecting their loan covenants. And what I would say is be careful of what I'll call it a catch-22. You've got a client that maybe without the PPP loan would have made different hiring or furloughing decisions for sure. I mean, let's face it, nobody's going to incur costs that they can't support through their operations. And the PPP loan probably had many of your clients making decisions that they thought were covered by the PPP loan. And to think that potentially that forgiveness, all or some, might negatively impact their loan covenants or their specific criteria that might say, hey, any income you recognize in 2020 related to the PPP forgiveness, we're going to ignore for your loan covenants. That may be a little too black and white. And the reason I say that again is, a client who broke even with before the PPP loan forgiveness is applied as income, more than likely would have made tougher decisions and perhaps, again, furloughed people and put themselves in a better economic position. This mitigated that. So I think thinking through how your clients might view the impact of forgiveness on their loan covenants, whether it's debt service coverage, debt to equity ratios, or just in general, a net worth potential covenant where the loan forgiveness covered expenses they may not have incurred. I think it's important that you think about that versus just kind of leaving it out there for, well, the terms of the loan are the terms of the loan. I think it's going to be important that you're thinking about that ahead of time as your clients are preparing their 2020 financial statements, that you're ready to understand how did they use those loans and how is it going to impact their covenants as they stand right now, if there's some inhibitor or some potential detriment to how they might account for these the loan forgiveness. So Jim, any comments on that?
No, I have not had a client that the relief of getting the PPP loan and then the ability not have to make those hard decisions that they would have had to make. They would have had to make them, and we would have been counseling them to do the furlough to let people go if they didn't have the money there. So they retained, across my client base, they retained employees that they normally would not have retained just because the PPP funds were available to them. So to then have them come through and get beat up because of that decision doesn't seem to make sense. And the PPP funds were there to keep them employed. That was the whole reason for the law in the first place. So they executed on what the government, I guess, wanted us to do. So hopefully they're not going to get hurt on the lending side.
Yeah. Sean, any questions or comments you have? I mean,
no, it looks like most of the it looks like, yeah, no, I definitely understand. I know we're working through that process internally. It looks like most of the questions that have been asked have been answered. Have any additional ones outside of, I think you guys did a great job of covering, and I know a large part of the audience was some guidance as to what to expect from the financial statements, and you guys did a great job of covering that. I'm keeping my eye to see if any more come in, but at the moment, I don't have anything else further to add. I appreciate you guys taking the time and really offering some guidance on this.
Sean, let me ask you a question. Have you had any clients who felt that maybe they didn't meet the need criteria and are contemplating paying the loan back in light of saying, hey, why don't I just nip this in the butt right now?
I have not yet. I've had a series of customers who are in the application process. One, I've had a couple who have received full forgiveness, but I haven't had any specifically say, you know what, I'm kind of uneasy about the questions or what may or may not come down the road. That hasn't been the case yet for any of my customers.
Okay. All right, good. Jim, any questions that you thought were, maybe we should pull up to the forefront? I think we got 1 minute left here.
I'm looking at them. No, there were some that talked about the FTE. I've let people go. They voluntarily left, or I let them go for cause. Does that hurt me on my FTE calculations? And no, there's exceptions to that under the rules where there's various exceptions. If you terminate them for cause, they voluntarily leave, you don't get hurt for that. And in most instances, when you go to 24 weeks, you've got so much expense, we're really not seeing much of a concern on making those types of decisions because the FTE percentage can drop rather low and still get 100% forgiveness. So you have to walk through your numbers in the workbook to see where you're at.
Yeah. One of the things I didn't even mention, it was in one of my slides where you may have clients who are using US GAAP and you may have clients who've converted to this framework for small to mid-sized enterprises. And that's one of those programs where, or a reporting criteria that may allow some of your clients to avoid some of the revenue recognition rules that are coming through, as well as the proposed lease accounting, which is going to require some value capitalization of operating leases, and they keep moving that starting point there. But these three accounting provisions that we discussed, the accounting for debt, the accounting for contributions, the accounting for grants, all three of those would meet the criteria under the FRF for SMEs. So that's a framework for reporting, financial reporting framework for small to mid-sized enterprises. So if you've got clients who are on that framework, all three of those would be would meet the same analogistic. I'm not even going to say that word anymore. The ability to apply another primary source of accounting to these PPP loans. Okay.
We're at 12:01, Tim.
All right. Hey, Sean, thank you so much. I don't know if you have any final words for a future RMA events or future RMA members to join, but I'll let you have the final word. We appreciate everybody online and their questions. If we didn't get to your question, Jim and I will probably stick around for a minute and type some answers in there, but I'm going to turn it back to you, Sean, for some final comments.
Absolutely. Well, thank you guys very much. As for future events with RMA, keep an eye out. We do have a series of virtual events works for 2021, so keep an eye out for those. And then, as I mentioned, the annual golf outing will be held June 7th at Tanglewood Golf and Country Club. So get the calendar now, and then keep an eye out for future RMA events. But we really appreciate everybody joining. We appreciate, Clayton, your time and energy spent on it. It's been very helpful and a lot of good information. So thank you, everybody. Have a great day.
All right.
All right.
Thanks, Sean. Thanks, Jim.
Yep. Bye.